Hello and good morning, folks. It's pouring out quite pleasantly out here in Mumbai, and we hope you have your cup of tea or coffee as we bring you the fresh brew of financial updates. It's the inflation week, and we have had the Indian CPI data released yesterday, which was marginally up from the expectations at 7%. Now, participants seems to be taking this positively as the currency saw some small slight equities look to be continuing their positive push in the off-market course. Another inflation data for another major economy is expected today. Yes, that's the US economy. And folks, these inflation data are the ones influencing the rate hike decisions and aggressions of the central banks to some extent. So inflation continues to be the focus as a bigger devil to manage currently. And we are seeing on and off different surveys on the kind of rate hikes that is being expected. So JK, I'd like your update on the Indian inflation as well as our expectations for the US inflation and accordingly the central bank actions.
Good morning. So we are back into a lot of action on the data market and expectations. Of course, to start with, this Indian inflation came much higher than expected. 6.9 was the headline inflation expected. It went to 7%, mainly driven by higher food prices. Actually, that has more than eroded the gain that we got out of fall in crude prices, and this is compared to 6.71 in July. And so I don't think it is such a big concern for the market because food inflation being higher during the festival season is anyway expected, and broadly we are anyway trading above the 2 to 6% band, which is mandated to RBI. And this, even if we had come to 6.71 or 6.9% as expected, we still have had RBI hiking rate. So this has no fresh policy implication. That is why the market has taken it positively, according to me. And of course, now we are into the next big data, that is the US CPI, and that is expected to moderate on a month-on-month basis to actually minus 0.1%, and the core year-on-year is slightly expected to inch higher. In any case, the focus will be whether the broader inflation is higher, because the crude prices being lower, the the headline inflation is expected to moderate, but it's a core inflation which includes a broader spectrum of commodities and services that will be the focus on the market. But if you look at the markets yesterday, I think there was big move in the yields in the US, 10s rising 11 bps from the lows, and 30s rising 12 bps, and actually 30s closed about 3.50 for the first time in this cycle. And there was no significant hawkish data that had to spur this move, more of a poor response to the big auctions of 3-year and 10-year paper by the Treasury. And the 10-year yield actually trailed by 2.7 BPs, despite being 56 basis points above the level at which it was sold in the last month. That was one thing. The market, the yield actually ignored the data of note, which was the consumer inflation expectations published by the New York Fed. Consumers saw inflation at 5.75 over the next 12 months, down from 6.2 in July. And for the 3-year, it was pegged at 2.8% to 3.2%. And more importantly, core survey on medium-term inflation expectations, the 5 years, of course, this can become a bit volatile, showed a decline to 2% from 2.3%. So coming to 2% means that actually inflation expectations are actually matching the inflation target for Fed. So you have the markets diverging from the fundamental news, particularly on the yields, but stocks definitely performed better, recouping more losses of the earlier weeks. And 0.75% from the Fed in September being well discounted. And, Powell has been laying a lot of stress on the inflation expectations. So this could be giving some heart to the investors. Investors are also encouraged by Ukraine's progress against Russian troops, which was reported over the weekend. In fact, some reports indicate Ukraine has gained 10% of the territory which was earlier lost to Russia. So we had a decent rally in the US stocks. I have to recall, one of the articles which was shared by my client, not to ignore correlations. Maybe this time that was meant to, show that, if the US markets are falling, the Indian markets may follow. But maybe it's working the other way around. Indian markets are taking the lead and other markets are following. So time will tell if that is going to be the true. So a dollar made up dip to another low point in this corrective slide with a rise in euro, obviously making a big dent. Euros rose sharply to 1.02 nearly, with two factors helping it. Ukraine news, which I mentioned earlier, as well as reports indicating that ECB may be inclined to take the policy rate to restrictive territory. It can be more than 2% terminal rate, which the market has been assuming so far. Broadly, market has ignored the hawkishness of the central banks, which have been, buying dollars. In the sense, we have had hefty rate rise by Canada, UK, ECB, and Australian and the New Zealand central banks. But so far, that was not reflected in those currencies. And now probably the market is trying to reprice the dollar, value. I'm not sure if this is going to become a larger trend, but definitely the excessive valuation on the dollar is getting corrected. That is what I sense. Also, the weekend official statement from Japan to counter excessive yen declines is also keeping a cap on dollar yen gains. In a somewhat significant policy move, Japanese government decided to remove the cap of 50,000 daily foreign arrivals into Japan, which was imposed as part of the COVID restrictions. It's not going to be a big, factor as far as the yen is concerned, but a small step towards, increasing the yen demand by tourists. That's how the market is seeing it. Maybe we have more policy measures. In fact, I'm still watching the 10-year yield in Japanese JGBs, which is once again trying to break out of the 0.25 cap. If that happens, it will be a very significant move, of course. We have some interesting news. The European draft proposal, which was earlier seen for 27 EU countries to introduce a solidarity contribution for the fossil fuel industries. Fossil fuel firms will have to share some of their excess profits to help the European households. So this is actually compensated for the non-agreement on the fuel price cap, which the EU countries did not come to. There was another report where it says that Truss is planning a new referendum bill that would mean Scotland could only win independence if 50% of those entitled to vote in favor, and not just a majority of those who vote. So this again is some sort of positive news for UK, because Scotland's independence has been at the background. Another interesting technical development, if you guys are interested, is the lot of talks on oil reaching $65 per barrel, a level which was seen well before the Ukraine conflict. This is seeing the traders betting on development in the technical charts, where the 50-day simple moving average crossed the 200-day simple moving average to the downside. And this is called a death cross in technical parlance, but we'll have to wait and see, because we do not know how the fundamentals are going to work out. Of course, in the short term, we have seen the oil bounce from below 90 by about $6, but medium term is something this development can be just assessed. Europe has also agreed to start discussion on shrinking its balance sheet in early October. Then Bank of England has postponed. Of course, this news came yesterday. I just wanted to highlight it that Bank of England has postponed its decision from 15th of September to 22nd of September in view of the death of Queen Elizabeth. So that's about summing up. Of course, on the rupee, yes, we had a stream of rather consecutive days of modest inflows, and that has actually capped the rise on the dollar yesterday also. In fact, we have seen a dent below 79.50, which was the previous bottom in the short term, and we have seen rupee trade at 79.35 in offshore market, possibly taking cues from positive risk sentiment as well as the oil, expectation on oil price going down further, and CPI report from US where people are expecting it to be lower. So all in all, it's a day on which risk sentiment is getting a boost. Hopefully, the inflation report does not disappoint us in this regard. Thank you.
Okay, wonderful, JK. And I'd just like to sum things up. As JK mentioned, the inflation was majorly driven by higher food prices, but since it's marginally high from the expectations and not too significant enough, or rather it has been majorly discounted by the market participants, we can expect there's no fresh policy implications and hence no fresh triggers in the markets, be it currency or the equities. On the other side, we saw some moderation in the inflation expectations for the US economy, and that can further change the route or the aggression of the central banks, even though a whole host of central banks are found to be quite aggressive in their policy stance, be it Canada or Australia or any other economy for that matter. One positive thing to cheer for probably by the stressed economies is the technical update that JK mentioned in oil. It's the death cross in technical terms. Let's just see how things go about, because a lot of economies would be wanting such kind of a move for the inflation to drop down and the energy prices to correct. So it's only times will tell how things go about. That's it for today, folks. We will be coming again tomorrow morning with another round of update. Till then, keep managing your risks and we shall meet soon. Thank you so much for listening.